This is the Friday, January 22nd, 2016 version of the Market Plus segment. Joining us now is Dan Hueber. Dan, welcome back.
Thanks very much. Glad to be here.
Well, and we are glad to have you. You mentioned on the program, we've probably got most of the bearish news priced in. We should have at least neutral, possibly bullish news in front of us. One of those bullish news events could be a weather event.
Oh, absolutely. Yeah.
And we've got a question here from Quentin. He followed us on Twitter. He's at The Grain Grower. He wondered, with El Nino or La Nina expected to, I'm guessing, peak or end in the late summer, what are our chances for a D16 high going to be in February or March? Could we include that volatility or that risk premium coming in early to the market?
Now we're referring to a year from now?
Yes.
Yes. And, and again, there is the challenge. My understanding, and by no means am I a meteorologist, if we saw El Nino peak and move to a La Nina, you'd have about a 2 or 3 month tail before that really makes an impact on domestic weather here. So if it changed right now and we cooled dramatically, we've probably set up for some weather issues, or at least a stronger probability of weather issues, summer of 2016. Now, realistically, if that peak doesn't come until summer, count 2 to 3 months out, then we're talking about dry fall. Not much of a market mover at that point. No. So it would have to be some other type of weather event if that was going to upset the market. So much of it's just, life is timing, I guess.
Right.
So, yeah.
If it comes in the fall and then it gets very cold, we could probably concoct some kind of semi-diesel gel and get some basis pop out there in the countryside.
Or maybe some winter kill in the weed or something.
Yeah.
There could be any kind of, but of course now we're fantasizing. But
yes, we are fantasizing.
At this point, why not? So
okay.
Yeah.
Well, now, so Quentin brings up $4 corn. We've got another question from our good buddy Phil up in Ontario, Canada. He's mentioned that $4 corn futures seem science fiction for old crop corn. Mm-hmm. Does D16 futures, do they offer any hope as we look out through the growing season? And let's take that weather event, La Nina, El Nino, out of the equation.
Sure.
Are there enough fundamental factors to drive us to $4 corn?
Personally, I think short term, and when I say short term, the next week, 10 days, I think we could approach it, $3.95-ish. I don't know if we could quite get a $4 out of it. That said, you can manufacture your own $4 corn by using some instruments at this point as far as short options and things of that nature. When you look at the December corn of the last year, we've really had about a 425, a 450 upside limit. I don't think that's impossible, but absolutely it's going to take a weather event. And I think probably one of the greatest things working in our advantage right now is we're sitting here, we've eliminated the weather pricing structure. I think we've kind of taken out that probability. I think everybody's assuming we're just going to have a normal year ahead. Well, give me a year we haven't had some kind of a scare somewhere, at least enough to push us back up into the upper side of trading ranges. And like I say, I think on December corn, that's 420, 450, but absolutely, there's going to have to be a hiccup somewhere. In a supply side market, you have to have a weather issue to make prices move.
And so do you anticipate 2016, possibly 2017, absent some fundamental changes, being a lot like 2015, where we could have, we had a weather event last year, that very wet spring,
certainly
sparked a very long or a very large rally.
Oh, sure.
It was very short-lived.
Well, which as a whole, weather markets always are. Even on some of the most intense weather rallies, if you've got 5 weeks out of it, that's huge.
Yeah.
Weather markets are a flash in the pan and they're over with. And I think, and again, back to that macro picture, in the greater scheme of things, there becomes the challenge in marketing in the years ahead, because, when you look at that 30-year commodity cycle, we'll have 5 years of this phenomenal demand-generated price growth. Then you're back to 20 to 25 years of supply-dominated, stagnant markets, which the rally opportunities come because somebody's had a crop problem. So it's a net sum game at that point. Somebody's going to have to lose to get a better price. If you're not ready to take advantage of it, those moves are done quickly, and you don't often get that second and third chance as you do on that great demand market. So.
Okay. Right. Now, you touched on something. There's a way to manufacture that $4 corn. Mm-hmm. And that kind of leads us right into John and Jessup's question. What is a good forward contract strategy for corn this year? And could you elaborate a little bit on how to manufacture that?
Certainly. As an example, and we've been talking about quite a few clients about this week. As I said, I think just looking at the short term here, we could probably push up December corn $3.95-ish. Again, I think we're going to maybe fall a little bit short of the $4 range. Certainly go ahead and make sales at that point with what you're comfortable with pricing ahead. And of course, most people don't want to be any more than 50 to extreme would be 70%, depending on what kind of crop insurance levels you take. Then turn around on the additional bushels and short out of the money call options. Use as short a time duration as possible because you want the time erosion to work for you. So if you can put another 10 or 15 cents or even 20 cents on top of with that short option, never do more than what your total production is because you could end up short on those short calls as well. But if it's just on time erosion, now you've put another 15 cents, let's say, on top of your corn. So instead of $3.95 corn, you've got $4.10. So.
How far out of the money would you go? Because a lot of guys do get concerned when we're shorting anything.
Sure.
It's pretty easy to become a speculator with a crop problem.
Oh, absolutely. You know, we will tend to look at where the range is in the corn, as we discussed a little bit earlier. 430 to 450 tends to be the upper side of the market range right now. So you want your short calls there or higher.
Okay.
So,
450, 460, whatever your risk tolerance would be at that point.
Yeah. And again, I mean, as we touched on earlier, marketing doesn't stop because you made that sale or purchase or whatever the case may be. It has to be managed on an ongoing basis. So don't think you could just walk away from it and say, hey, I'm done for the year.
Right. Not in this environment.
Absolutely not.
Now, we did talk a little bit about the cattle market. It sounded like you were a little positive about it. Right. Chris in Cuba City, Wisconsin from Facebook is wondering, do you think the cattle market has put in its 10-year cycle low this last fall, that last low we had, or the new lows await us here in 2016?
You know, I'm not normally a big optimist on many things, but yeah, I would like to think that low is in there. You know, and again, I think the public has a taste for meat in their diets, and you know, granted, we're not growing leaps and bounds in this country, but on the same token, we're not suffering either. Unemployment numbers continue to get better. Wages are incrementally moving higher, but I mean, I think people want to keep that meat in the diet. You know, granted, our population's not growing a lot, but it still grows. I mean, so we've got more mouths to feed every year. So yes, I think those lows are behind us here at this point.
And it is incredible how the U.S. consumer has still been willing to pay historically high retail beef prices.
Oh, absolutely.
That's, I think, an indication you might be onto something.
Sure, there we go.
Now, I want to take a look at the market that's really driven. Anybody who's watched CNBC or any of the nightly news shows has heard about crude. Crude keeps falling, except for this week we caught a bounce. Where's crude going from here?
You know, and not that you can immediately look for any kind of a major turnaround in the crude oil market. I really think we had already moved beyond what made fundamental reasoning. You know, as we continue to push below the $30 mark, even below $35, I don't think makes a lot of fundamental sense. We're not going to slow down the production just because we've gone lower. We're not necessarily going to pick up demand because we've taken prices cheaper. And I think, you know, it reached a point where fundamentally it really made no sense. It was all about money. You know, the trend is your friend. We've made money selling it. We're just going to continue to sell it until proven wrong. Now, I can't totally say they were proven wrong this week. I mean, a 9% bump scared a few people back out of the marketplace, but I think that's one of those warning flags. If they try to press it again, we snap back again, then I think we've got a pretty good probability that, you know, we've gone too far. We need to kind of balance this out and see if let the pieces fall back together at these price levels.
Okay. So. Now, one of the headwinds that we've been facing beyond the drop in crude, scaring, as you mentioned, money away from commodities, this strong dollar. This dollar index is historically high relative to the past 15 years.
Correct.
Can we climb ever higher in the dollar index?
You know, ultimately, the answer has to be yes. I mean, we're by no means at historical record highs. That said, you know, we've really been at this range, just sub the 100 mark, since spring. And, you know, about every time it looks like it's ready to roll over and maybe push back into a little lower level, we'll have a China or we'll have, you know, some other kind of economic turmoil. Everybody wants to have a flight for safety. The dollar is still that world currency where they're going to go there. But even with all of that, we've not really advanced. So it is a situation that my tendency would say, yes, we have probably a decent probability of seeing a correction there if we could just take some of these other calamities out of the way that panics the traders into that dollar again. So
now, how are things looking in China? They've been a big driver of headlines over the past year. This slowdown, their stock market debacle. Fundamentally speaking, how do things look in China?
You know, and of course, as with anything, you know, when something big happens, you know, we're going to hear all the news on why it's going to be so bad and why it's going to continue to be so bad, and you know, that's just market psychology. You know, realistically, they still posted a 6.9% GDP. I mean, that economy, they've made missteps, don't take me wrong, probably more market missteps than necessarily economic missteps. I mean, not that you can totally micromanage an economy for a 1.2 billion person population. But that said, you know, even from the demand side and the ag products, I mean, there's already projected there's going to be record soybean meal demand in China as they rebuild the hog herds over there. I mean, they have issues, but I mean, I think most of this is just that readjustment period. Everybody expected them to continue to grow at this 8, 9, 10% rate, which was unrealistic to begin with. Demographics were totally working against them for that to happen. But once you've kind of disappointed those expectations, you know, all right, now we have to kind of readjust to where that, who else is going to pick up the slack? I mean, there's probably our biggest challenge. There is no other country right now that's stepping in, filling in for the number 2 economy in the world. Not that they won't develop, but, you know, it's just readjustment period.
Right,
So.
it's an adjustment. Well, Dan, thanks so much for taking the time to join us this week.
My pleasure, thank you.
Thanks to all of you for sending in your questions via Facebook and Twitter. Please continue to do so, and we will get expert analysis right to you. Thanks for watching, and have a great week.